It's Monday, 17th of August, 2026. Welcome back to your news update on Blip Brief, crisp but almost everything updated every market trading day. Imagine setting up a toll booth on the single busiest highway in the entire world and then just randomly deciding to drop the barrier.
Right. Complete gridlock.
Exactly. And over the weekend, that barrier basically dropped in the Strait of Hormuz. We're talking about recent tanker attacks, entirely stalled geopolitical negotiations. I mean, the primary artery for global energy trade is essentially at a standstill right now.
Yeah, it's a profound geopolitical choke point.
It really is. And the shockwaves, they are already eating into our domestic market's momentum. I mean, this tug of war between, global friction and Indian macroeconomic resilience, it's exactly what the markets are pricing in right now based on the previous closings.
They absolutely are, because when a choke point like Hormuz tightens, the entire global macroeconomic landscape shifts, literally within hours. The immediate, just reflexive reaction is a sharp upward percentage spike in global crude oil prices.
Which we saw instantly.
Right. And for a rapidly expanding economy like ours here in India, which, imports the vast majority of its crude requirements, this isn't just some distant geopolitical squabble.
No, it hits home immediately.
It translates instantly and forcefully into imported inflation. Every barrel of oil that takes a longer, more expensive route around the Cape of Good Hope or carries a significantly higher insurance risk premium that directly pressures the Indian rupee.
It's the downstream premium. If you control the headwaters, everyone living down the river pays the price.
That's a perfect way to put it.
And we are seeing the direct consequence of that premium in the currency markets right now, aren't we? Based on the previous trading sessions movements, the Reserve Bank of India has essentially been forced into the trenches.
Yeah, they are in full defense mode.
They're aggressively defending the rupee against this really intense downward percentage pressure. But what does that defense actually look like? On the trading floor, what are they doing?
So it is a massive, highly coordinated deployment of capital through open market operations. When imported inflation threatens to just drastically devalue the currency, the central bank intervenes directly in the foreign exchange markets.
So they're stepping in as the big buyer.
Exactly. They utilize their foreign exchange war chest to aggressively sell dollars and buy rupees in the spot market.
Right.
And by doing this, they artificially absorb excess rupee liquidity. The goal, and this is important, the goal isn't necessarily to peg the currency at a specific, rigid level.
They just want to manage the volatility, right? Stop the bleeding from being too fast.
Precisely. They want to ensure that any depreciation is a gradual, controlled glide path. They want to avoid a sudden, steep percentage drop that, panics foreign portfolio investors and just completely shreds the import planning for domestic corporations.
So they're basically acting as the buyer of last resort for their own currency, effectively vacuuming up rupees to create scarcity and support the value.
That's exactly the mechanism, yeah.
But, and here's the catch selling dollar reserves to buy rupees, that burns through that war chest. It is an incredibly expensive defense mechanism to keep up.
It's massively expensive.
Yeah.
You can't do it forever.
Right. Which brings us to the inevitable question for your portfolio if you're listening right now. If crude is squeezing our currency and the central bank is deploying heavy resources just to stabilize the exchange rate, is this global friction just suffocating our domestic growth?
Well, see, if you look strictly at the external pressures, you would absolutely expect a severe domestic contraction.
It seems unavoidable.
It does. Yet, transitioning to the domestic front, the macroeconomic data reveals a surprisingly resilient narrative. India's first quarter economic growth is holding incredibly strong. We're staying firmly above a 7% threshold.
Wow, despite the oil shock.
Despite all of it. And on top of that, July retail inflation is holding surprisingly steady at exactly 4.4%.
Wait, let me push back on that math for a second because it feels totally counterintuitive. We have global crude prices spiking, freight costs are escalating by, double-digit percentages due to this Hormuz standstill, and the rupee is actively under siege.
Yeah, the macro headwinds are fierce.
Right, yet domestic inflation is flat at 4.4%, while growth stays well above that 7% mark. How is the domestic engine completely ignoring this massive influx of global friction?
Well, the thing is, the domestic engine is not ignoring the friction. It is out-muscling it through sheer internal velocity.
Out-muscling it. Okay, how?
The momentum here is dual-powered. It's driven by fierce domestic consumption on one side and robust, sustained government capital expenditure on the other.
So the CapEx is acting as a floor.
Yes. And when you examine the microindicators, The mechanics of this resilience become really clear. Take the recent Independence Day sales data, for example.
Ah, yeah, those numbers just came out.
Right. We saw value sales across categories surge by up to 25% compared to the previous year.
25% is massive.
It's huge. But meanwhile, actual volume sales increased by only 5 to 7%.
Okay, that's an interesting gap.
It is. And furthermore, if you look at e-way bill generation, which, is a highly reliable real-time proxy for the physical movement of goods across the country's logistics networks, that rose by nearly 6%.
Okay, so if you are looking at the ground reality, you definitely see this momentum. I mean, the malls are packed, logistics networks are operating at peak capacity, trucks are moving, goods are clearly moving.
The physical economy is humming.
But I really want to zero in on the disparity in those sales figures you just mentioned. Value sales surged by 25%, but volume only increased by 5 to 7%.
Yeah, that's the catch.
That tells me consumers are buying slightly more physical items, but they're paying significantly more for them.
So are companies actually making money off this volume, or are they just passing on all these imported inflationary costs under the guise of, premiumization? That is the million-dollar question. Because if you look beneath the surface of that 25% surge, the narrative changes entirely. You are pinpointing the exact divergence that institutional investors are tracking right now.
The gap between the top line and the bottom line.
Exactly. That gap between value and volume indicates that top-line revenue is exploding, sure, but the underlying health of the profits is a completely different story.
Right.
If we connect this consumer spending boom to the latest first quarter corporate earnings, the divergence is just stark. Revenue growth for India Inc. hit a massive 19.4%. I mean, that's the strongest top-line expansion we have seen in at least 9 quarters.
Right. So corporate India is running 20% faster on the treadmill, but only burning 11% more calories because the incline keeps getting steeper.
That is a highly effective way to visualize the mechanics of a margin squeeze. Because despite that 19.4% top-line revenue explosion, corporate profit growth lagged significantly. It came in at just 11%.
A huge drop-off.
Yeah, and this connects directly back to what we started with, the Strait of Hormuz and imported inflation.
Ah, the input costs.
Right, rising input costs, which are driven by expensive crude, elevated logistics expenses, and broader commodity inflation, they're aggressively eroding corporate margins alive.
So the revenue is vanity, but the margin is sanity.
Always.
The companies are generating massive sales, and consumers are clearly willing to spend, but the cost of raw materials and transport is so incredibly high that it just vaporizes the actual profit before it ever reaches the bottom line.
It does. The input cost pressure is just relentless across the entire supply chain. And companies, they naturally attempt to pass these rising costs onto the consumer, which perfectly explains why the value of sales is up 25%.
Right, the sticker price goes up.
But there is a strict ceiling to consumer elasticity.
Meaning they'll just stop buying.
Exactly. You can only raise the sticker price of a smartphone or a fast-moving consumer good so many times before the buyer simply walks away.
Right.
So eventually, companies are forced to absorb a significant percentage of these rising costs internally just to maintain their market share.
They have to eat the cost.
They do.
Yeah.
And that internal absorption is exactly what compresses the overall profit margins down to that 11% figure.
Yeah.
This margin squeeze is the tangible, quantifiable cost of global geopolitical friction on our domestic enterprise.
Wow. So if you are wondering why the IT stocks in your portfolio took a massive hit last week, despite reporting, record sales, this margin squeeze is exactly why.
100%.
The market is absolutely not blind to this divergence between top-line vanity and bottom-line reality. And because of this margin compression and the undeniable global headwinds, we are seeing significant repricing at the top end of the market.
The Wall Street is repricing the risk.
Exactly. Based on the previous week's closings, top-tier market heavyweights, particularly the IT bellwethers, saw significant double-digit percentage drops in their market capitalization.
Yeah, the sell-off was fierce.
The market is aggressively recalibrating the value of these firms based on compressed profitability, just entirely disregarding their impressive revenue figures.
Because revenue doesn't equal resilience when the margins are collapsing. We are witnessing a ruthless reevaluation of capital allocation.
And where is that capital going?
Well, when profit margins compress and global macroeconomic risks escalate, institutional capital immediately seeks efficiency and security.
Flight to safety.
Exactly. And this dynamic is triggering a massive, highly strategic shift in the money markets right now. We are currently observing foreign banks operating in India aggressively ramping up their foreign currency, non-resident or FCNR deposit collections.
Wait, FCNR deposits?
Right. They are fiercely closing the market share gap with local domestic banks to secure foreign capital.
Okay, let's break down the mechanics of that FCNR push for a second. Why this sudden aggressive appetite for NRI deposits by foreign banks? If the rupee is depreciating and margins are shrinking, how does taking in foreign currency deposits from non-residents act as a shield?
It's all about liability management. FCNR deposits allow non-resident Indians to park their funds in foreign currencies, usually dollars, completely insulating the depositor from rupee exchange rate risks.
Right, the depositor is safe from the rupee slide.
Yes. But for the foreign banks taking in these deposits, it acts as a crucial asset liability match.
How so?
Well, think about the macro picture we just painted. The central bank is burning through reserves to defend a depreciating rupee, and global dollar liquidity is tightening due to geopolitical stress in places like Hormuz.
Dollars are getting harder to find.
Exactly. So foreign banks need a stable internal buffer of dollar liquidity. By offering slightly higher yields to secure these FCNR deposits, they're basically building a fortress of dollar-denominated liabilities.
Ah, I see.
It ensures that if the currency markets experience sudden, violent percentage swings, these banks are not caught completely unhedged, scrambling to buy expensive dollars on the open market just to meet their obligations.
Oh, that makes total sense. It is a defensive perimeter being built in real time. They are hoarding dollar ammunition to survive a protracted currency siege.
That's a great analogy, yes.
But in the midst of all this margin compression, capital hoarding, and market cap bleeding, there has to be a segment of the market that is navigating this successfully. I mean, where is the silver lining for investors who are just staring at a landscape of rising input costs?
There actually is one. The silver lining exists specifically where targeted fiscal policy interventions intersect with robust domestic demand.
Okay, where are we seeing that?
While broad markets definitely felt the heat of the margin squeeze, specific sectors like automakers are actively being buffered against these severe commodity costs.
Oh, because of the recent policy changes.
Right. This sectoral resilience is largely thanks to recent percentage cuts in the goods and services tax, the GST, for specific automotive categories.
So the government is essentially stepping in to act as a shock absorber for the auto sector. By lowering the tax percentage on the final product, they are artificially giving automakers the margin room to absorb those higher crude and commodity costs without ruining their profit.
Yes. The companies don't have to crush consumer demand with massive price hikes because the tax cut offsets the supply chain inflation.
It demonstrates exactly how precise fiscal policy can neutralize the effects of imported inflation. The automakers maintain their margins, the consumers don't face a massive sticker shock, and volume growth is actually sustained.
It shows that when domestic policy actively clears the path, internal consumption can translate into actual, sustained corporate health, even when global supply chains are in complete turmoil.
Man, that's fascinating. But, we have spent this entire deep dive entrenched in an economy currently being held hostage by 20th century energy logistics.
Yeah, oil and shipping lanes.
Exactly. We are talking about the physical movement of crude oil through a single geographical choke point dictating our currency valuation and corporate margins. But what if we could bypass that entirely?
Now we're talking.
What if the highest level technology of the 21st century didn't rely on massive, centralized, geographically vulnerable power grids at all? We have news from the scientific community that basically fundamentally alters our understanding of quantum mechanics.
Yeah, this story is incredible.
Scientists have successfully generated quantum entanglement directly from ambient sunlight.
It is a profound leap forward in physics, and the mechanics of it solves a massive logistical bottleneck.
How so?
To understand the gravity of this, we really have to look at how quantum technology currently operates. So quantum entanglement is a state where two particles become intricately linked, meaning the state of one instantly dictates the state of the other, regardless of the physical distance between them.
Spooky action at a distance, right?
Einstein's favorite phrase, yeah. And it is the foundational requirement for quantum computing and ultra-secure quantum communication.
Right.
However, previously, forcing photons into this entangled state required highly concentrated, incredibly energy-intensive lasers.
Huge power draw.
Massive. It was a process that demanded sterile, hyper-controlled laboratory conditions, cryogenic cooling, and just massive continuous power from the grid.
So using those massive lasers is like trying to brew a single artisan espresso using an industrial water cannon and a dedicated power plant.
Pretty much.
It works, but the energy required is astronomical and completely unscalable outside of a multi-billion-dollar lab. But with this new research, instead of the water cannon, you are basically using a magnifying glass and the sun.
Yeah.
You are taking something chaotic and ambient natural sunlight and using it to trigger the most precise, complex physical state known to science.
It's beautiful, but let's refine that analogy just a bit because the mechanics are even more elegant than a magnifying glass.
Okay, tell me.
You don't even need to forcefully concentrate the sun's rays to the point of, burning something.
Yeah.
The researchers developed a specialized, highly advanced lens array.
Lens array.
Right. This lens takes the broad spectrum ambient energy of the sun and passively filters it. Passively. It isolates the exact specific wavelengths required to excite specialized nonlinear crystals.
Wow.
So when the sunlight hits these crystals through the lens, they naturally emit pairs of entangled photons. There is no massive power grid required.
That's
There are no energy-intensive lasers, just a passive optical filter, a crystal, and the sun.
That completely changes the trajectory of how we build the next generation of global technology infrastructure. I mean, if we don't need dedicated power plants and sterile laboratories just to maintain quantum states, the scalability of quantum networks entirely transforms.
It's a paradigm shift.
It takes things like unbreakable quantum communications and advanced quantum sensors out of the theoretical laboratory and pushes them closer to everyday low-energy field deployment. We could literally be looking at a future where quantum infrastructure is powered as passively as a modern solar panel on your roof.
And if we connect this technological leap to the broader macroeconomic picture we've analyzed today, it leaves us with a really compelling thought to consider. If human ingenuity can engineer a way to harness simple ambient sunlight to power the most complex, sophisticated quantum mechanics on Earth, how much longer will 20th century physical bottlenecks like the Strait of Hormuz be allowed to dictate our 21st century market margins?
That is the question.
We are currently watching the friction of the past, attempting to hold back the infinite decentralized scalability of the future.
And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.